What's up, everybody? Welcome to Heresy Financial. Today, we are going to be looking at the fact that quantitative easing is by nature inflationary, despite what some other people might have said and the way they try and explain around it. Those arguments fall flat. They're flat out wrong. They don't work, and I'm going to prove to you how. Ready? Let's dive in. Now, apparently there is some debate out right now about whether the government spending money and the Federal Reserve printing money in order to indirectly finance that spending has an inflationary effect or a deflationary effect. Now, one of the voices that is loud in this space, specifically trying to describe why he believes that QE itself, because of the mechanics, is deflationary, is Stephen Van Meter. And so I'm going to show why it's incorrect. So the first argument that's used here to say that QE is deflationary is because they say that banks have to actually lend for the mechanics of QE to be inflationary. Now, 100% that is true, but that doesn't mean that QE is deflationary. Nobody is claiming that the expansion of the money supply has an instantaneous effect on all prices going up. That's ludicrous. Nobody actually says that. There is a trickle-down effect with inflation, also known as the Cantillon effect. When you have an expansion of the money supply, the first thing that happens is it bids up asset prices and you have asset price inflation. The next phase of inflation after the money supply increases is that consumer prices, just like goods and services, those prices go up. And then finally, the last stage is wages go up. Wages are lagging. They're one of the last things to be affected by changes in the money supply. And interestingly enough, this is the same order of events when you have a system with a stable money supply where the money supply doesn't change. When you see deflation over time, like in the period of history between the Civil War, like 1870, to the period of time when the Federal Reserve was created in like 1910, you had deflation that entire time, price deflation. Usually it followed the same pattern of asset prices, then goods and services, and then wages. And so people became way more wealthy on a real basis when you looked at how far their purchasing power went, their cost of living, their quality of life. People got much wealthier during that time because their wages weren't adjusted downwards in nominal terms until after they had already had the wealth effects from that. So deflationary systems benefit the poor, inflationary systems benefit the rich. So that's the first thing. Nobody is saying there's an instantaneous effect. There is absolutely a lag between the time when the actual money supply increases by a lot to the time when it makes its way throughout the system, because usually the money supply is increased when there's some sort of a crazy shock, like a market crash or a pandemic. And so you're going to have a period of time where people aren't spending money, they're holding back. And so yes, there's going to be a lag. It doesn't mean that the money printing isn't inflationary. It just means there's a time lag between that. And he even kind of alludes to this because Stephen Van Meter specifically says it's deflationary until it's inflationary. Well, yeah, it's just inflationary. It just takes a little bit of time for it to work itself out through the system. Yes, you need banks to lend. Yes, you need there to be demand. Yes, you need people to spend money. But those things happen as as a consequence of this money printing. It just takes a little bit of time to work through the system. Now, let's even put that to the side, because quite honestly, that part doesn't even matter. You could get rid of bank lending. You could get rid of the Cantillon effect. You could get rid of some of these things I'm talking about. And we just need to focus on one thing to prove why money printing is inflationary by definition, inherently by nature: government spending. Regardless of how the mechanics of QE work, that they're just swapping, assets for reserves at the banks, doesn't matter. QE finances government spending. Here's what I mean. In a normal system where the government wants to spend money, they have two ways to get their hands on money to spend. The first way is taxes, right? You pay us money, we're going to spend it in other ways. It's just redistributing assets from one portion of an economy to another, and usually that other is just their own pockets, right? And so that's the first way. That's in a closed system, there's no inflation there. The money supply doesn't change. I take money from over here and I place it over here. The same amount of money. You're going to have isolated instances where some prices go up and down as a result due to money supply imbalances caused by intervention, where the market's not setting that. But overall in the system, money supply doesn't change. It's not going to be inflationary. The second way that they can get their hands on money is by issuing bonds. And this is the government saying, hey, we want to spend more money than we can get from taxes right now. So does anybody want to lend us money? We'll borrow and we'll pay you some interest, and 2 years, 10 years, 30 years, whatever it is, we'll pay that money back to you. Now, question, is this inflationary? No, it's the same thing as taxes. It's simply taking money from one place in the economy, usually, retirees, pension accounts or retirement accounts or other investors, and they give their money to the government. And so it's taking money from one area, putting it into another area. Now, in isolated circumstances and temporarily, this can cause price imbalances, right? Because you took money that maybe wasn't going to be spent because it was looking for, safe harbor, it was looking for, a CD or just to be held in cash or whatever, and you're going to give that to the government who's going to spend that. It's going to bid up prices. But what happens when that bond is due? In a normal system, it's paid back, right? So then the same dynamic reverses itself. So if you had any imbalances or if you had any localized price inflation effects from that government spending, well, now the opposite has to happen, because since the government has to pay back that money, they can only pay that back through income derived from taxes. And so the extra government spending that happens now from that debt, from that borrowing, will be offset in the future when that government spending is a lot smaller in order to pay back all that debt. Now you might be thinking, okay, you must be thinking of a country other than the United States, because clearly paying off debt is not something that has happened in a very long time. And you're right, I'm talking about a hypothetical country that doesn't exist, because governments don't pay back their debt, they just continue to issue more debt. So before I move on to that, I want to make a point that this is one of the other reasons why, especially Stephen Van Meter says that QE and money printing is deflationary, because he says that, hey, with fiscal money, the more the government spends, that's just money they borrow and they have to pay that back. So that's deflationary. That's not true. They don't pay it back. Number one, they just continue to roll it over. And number two, it's not actually deflationary in total if they were to pay it back. All they're doing is undoing the prior inflation they did before. When you borrow money and pay it back, the amount of money in the system doesn't change. So that's not inflationary or deflationary. You've got temporary imbalances through time and through local areas of the economy, but overall it's not inflation or deflationary because that money supply doesn't change. Okay, so then how does the money supply actually change? Well, the money supply would actually change when you've tapped out the ability as a government, when you've tapped out your tax resources, when you're taxing the economy as much as you can before you become too much of a burden to where the economy collapses on itself. So you've reached your limit on how much you can pull out of the economy from taxes. There's no other money willing to lend to you, but you still have to be able to pay for your current expenses and pay off that old debt. So that's where QE comes in. That's why they named it quantitative easing. That's why Bernanke called it quantitative easing, because he didn't want to call it debt monetization. That's what it is. It's the Federal Reserve firing up the printers and buying that government debt. It's the printer, it's the new money that's being lent to the government, giving them extra spending power. Now, when this whole thing started, they said, hey, this is temporary and we're going to undo it. And theoretically then, yes, that still would not be inflationary if they ever undid that. If the Federal Reserve ever told the United States government, hey, you have to pay us back and we're not going to issue you new debt in order to pay off that old debt. You just have to pay off all of that debt that you owe us. If something like that ever happened, all you're doing is undoing the inflation that happened before. The money supply has expanded enormously over the past few decades simply because of all of the government spending that's been financed by debt that's never going to get paid back because it was funded by a money printer. And every time that debt comes due, all the government does is they take out new debt to pay off that old debt. Now, curiously, $1 trillion worth of government debt is going to come due within the next couple of weeks through the end of the year. Yes, $1 trillion. And so in a normal system, if everybody who held that government debt said, no, we actually want our money back, that would undo the inflation that happened before. Government spending would have to decrease in order to compensate for what they had to pay back. Now, that's not going to happen. They're going to issue the same amount that is coming due. So you're going to see $1 trillion expire. You're going to see $1 trillion new issued. And guess what? A lot of that, obviously I don't know how much, but I'm willing to bet that a very good portion of that $1 trillion will come from the Federal Reserve. Now, it's indirect. It goes through the banking system, sure, but that doesn't change anything. If the Federal Reserve wasn't there to pick up the slack and lend money to the government that the economy can't lend to it, and give that spending power to the government that the economy can't through bonds or through taxes, then the price of bonds would collapse so that interest rates would rise. rise and the government would actually be insolvent. And so we have a couple dynamics in play in real life that prove that it's actually inflationary, because number one, this government spending train that they're on, it's never stopped, and it doesn't look like it's going to stop anytime soon until it all collapses on itself. And number two, the fact that they're borrowing doesn't actually mean that they're going to pay it off. That debt is never getting paid off, and it never has to get paid off, because the Federal Reserve will continue to print in order to pay off that old debt and fund the new debt and the new spending. That means that government spending is by itself expanding the money supply. And even if that trend was to reverse itself and that government spending was to go way down and all that debt was going to be paid off and they weren't rolling it over, and the Federal Reserve stopped its printing presses and they started selling all the assets instead of accumulating new assets, all you're doing is undoing all of the money expansion that happened prior. So temporarily, that looks like deflation, but over the long term, you realize all you're doing is undoing what came before. And this is what Bernanke actually promised in the beginning. He said, we're going to do this temporarily, and then we're going to wind down the balance sheet. That's what that meant. We're going to wind down the balance sheet. They've never been able to do that. They've tried. They can't do it. They won't do it. So this year, we've seen the first phase of the Cantillon effect, where all of this massive expansion of the money supply has pushed up asset prices, number one. And next year, we're going to see phase two start, where we see prices, consumer prices, start to skyrocket all across the board. Yes, there's a lag. Yes, it is inflationary, and there's no way around it. But tell me what you think. I welcome your comments. I want to hear some pushback, want to hear some criticism, want to hear some questions. Let me know what you think in the comments section below. And lastly, if you want to protect yourself by buying gold, by buying silver, buying Bitcoin, or if you want to just learn more, I've got all of my recommended resources, my courses, my guides linked in the description below. As always, I really appreciate you guys. You really are the best. Have a great day.